Welcome back. Earlier today, the Federal Reserve met, and the Federal Reserve held off on an interest rate hike during its regularly scheduled September meeting. Since March of 22, the central bank has raised borrowing rates 11 times, this time keeping them unchanged. Federal Reserve Chairman Powell, in part, said recent indicators suggest that economic activity has been expanding at a solid pace. Job gains have slowed in recent months but remain strong, and the unemployment rate has remained low. Inflation remains elevated. The U.S. banking system is sound and resilient. Tighter credit conditions for household and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. The committee remains highly attentive to inflation risks. He continues, the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to maintain the target rate for the federal funds at 5.25 to 5.5. The committee will continue to assess additional information and its implications for monetary policy. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations and financial and international developments. Well, what we're looking at here are the Fed funds futures from present day through December of next year. The red line represents the probabilities that we're going to see unchanged decisions the next meeting is November 1st, 23. The black line represents the probability of an interest rate hike. The green line represents the probability of an interest rate cut, an ease. Well, at the moment, we see there's nearly, or a little bit actually above, a 70% chance that in the next meeting in November, the Federal Reserve will not raise interest rates. Red means unchanged. There's only a maybe 28% chance that the Federal Reserve will actually raise interest rates and nearly 0% chance of interest rate cut. But notice what happens as we move forward in time, specifically January 31st of next year. The chances of no change and the chances of an interest rate hike nearly intersect around 50%, meaning the end of next January, we have a 50% chance the Federal Reserve will not change rates or raise interest rates. So essentially, what we're looking at is that there's a greater chance that they're going to raise rates. That actually, the best chance the Federal Reserve will raise interest rates is January, the end of January of next year. So, and as we move closer, we're looking at a period of time right now where we see pause. The Federal Reserve paused today. It's probably not going to raise rates. At least this is what the Fed funds futures are telling us right now, is that they're not going to raise rates in the next meeting in November and probably not in December, but January 31st, 50% chance they will. Now, of course, this is all contingent on the next stream of economic numbers. Federal Reserve said that they're certainly very closely watching inflation. They said, yeah, unemployment rate is low, the labor market's a little soft. We saw that. I think personally they're downplaying it. You go back and watch our non-farm payrolls video, we see year over year we're at yearly lows. I know the unemployment rate is 3.8%. That's a little bit of an uptick compared to the 3.6% prior report, but still, the unemployment rate really doesn't tell the whole story. But nevertheless, that's what the Federal Reserve is watching. This is today's change in U.S. Treasuries by basis points. The short-term bonds rally. 2, 3-month, 4-month were up around 1, 2 basis points. Not big moves. The longer-term bonds have sold off 1, 2, 3 basis points on the 7, 10, 20 year. So we're seeing that the shorter-term bonds are anticipating a little bit of a move towards higher interest rates. And again, January 31st is probably the best chance we have to see another interest rate hike, given where we are right now. If economic conditions change, certainly those odds will change. And we're going to continue to go back to that chart over time and see how those lines move. This is where current U.S. Treasuries stand. 4-month bond pays a 561. That's the highest yield we have. We have a 10-year bond at a 435. Now, I know this looks low, but we're going to see in a subsequent chart That's actually a very, very significant high, the 10-year bond. I know it doesn't look like anything here, but in the long run, it's actually a very high level. And this inverted bond market where the short-term maturities are paying a higher yield than the long term certainly tell us a very convincing story that the Federal Reserve is more likely to raise interest rates in the near-term future, but as we move into the long-term future, then we see chances of lower rates. And remember that first chart we looked at, over the long term, we actually are expecting interest rate eases, meaning lower interest rates. And that's what this is telling us. Now, here's a 1 month change in treasuries. The biggest increase has been in the medium term yields, 3, 5, 7, 10-year yields. We've seen some softening on the short term. I think that has been, and this doesn't reflect today, this reflects the entire month. And what this is telling us is that over the long term, we probably see, if I were to interpret this, because we see such resilient inflation numbers, especially taking into consideration the energy numbers, that inflation has been so resilient. I think this is telling us the bond market thinks that we're going to have higher interest rates for a longer period of time. Maybe if we were to look at that chart a couple months ago, we wouldn't see potentially higher rates through January of next year. Maybe it would have been December or even November. But when we see the yields move higher on the long term, it shows us on the long term, the Fed funds futures, meaning the market, all of us are expecting higher rates longer into the distance, further out into the distance. Now, this is going back to May of this year. So we have, about 3, 4 months worth of data. This is how bonds have changed. Most notably, take a look at the 2-year bond over here. This is this blue line, this dark blue line. In May of this year, we saw the 2-year paying around a 3.8%. We're now at a 4.8%, about a 100 basis point increase. The yellow line is the 3-year. That was a 2-year prior, then the 3-year. The green line is the 20-year, but let's exclude the green line for a moment. The 2 and 3-year, the medium term, and also the purple line, that's the 5-year. The medium term bonds have really moved up. And again, what this is telling us, while the short-term bonds, you take a look at this, the jagged purple line over here, that's the 1 year. The jagged yellow line over here, that's the 6 month bond. So these are the very short-term maturities. And this is telling us in the near term, expectations haven't changed. That we expect higher interest rates in the near-term future. That hasn't changed. That's nearly identical to where we were a few months ago. The biggest change is that we see the medium term bonds, the 2, the 3, the 5-year bonds move up about 100 basis points each. Also, the longer term bonds, like the 10-year, that's that red dotted line at the bottom. And that's telling us again, because inflation has been so strong, that the expectations the Federal Reserve is going to keep rates higher for a longer period of time. And that as weak as we like to believe the job market may be, especially those non-farm payrolls, which really are not good, it's not enough evidence to sway the market. It's not enough evidence to sway the Federal Reserve towards moving towards an easing stance, meaning that they're more likely to cut interest rates. They're not more likely to cut interest rates. Inflation seems to be the concern. And this really does tell us what the bond market believes the Federal Reserve stance is, which is exactly what they say. Inflation is the number one concern. Now, this goes back to September 2020. The black line is the S&P 500. The 10-year bond yield is in red over here. And we can see the 10-year bond was paying a 110, now up to a 410. So we have a 300 basis point move. And again, we've had 11 interest rate hikes over the past, a little bit more than a year. This red line shows us the tremendous amount of increase in inflation, a tremendous amount of increase in interest rates as well. Now, higher interest rates tend to weigh on the stock market. The stock market certainly doesn't like higher interest rates. It makes borrowing and expenditures that much more expensive. And interesting enough, around September of last year, when the 10-year hit these very significant highs, that's when the stock market really kind of said, listen, I think maybe this inflation is too much for us to bear, and that's why the stock market went so down. But from September of last year through, let's say, the end of the year, the beginning of this year, the 10-year bond yield started to waver. That maybe the expectation is inflation was under control, the interest rate hikes were taking effect, and maybe we're closer to an interest rate cut. I think that's what the market was probably telling us between this high and this low. That maybe inflation is starting to wane. Maybe the Federal Reserve does not have to be so aggressive. And maybe the stock market like that. The stock market says, hey, if the Federal Reserve is going to pull back a little bit, maybe stocks will have a little bit more room to breathe. What's interesting is that now the 10-year bond yield is at new highs, actually new multi-decade highs. We'll see in just a moment. What's curious is the stock market has not gone down the way it did, the way the 10-year bond yield went up last time. After all, the 10-year bond was at a 410. The S&P 500 went down to 3600. Now, I know over the long term, 10-year bond yields and the stock market tend to move in the same direction. It's very simple. Stocks go up and the bond market has to offer higher yields to compete with stocks. If stocks average 8% a year, then the bond market has to offer a higher yield. Well, what happens is that is under a period of economic growth. Right now, yields are going up not so much because of growth as much as because of interest rate hikes. So in that environment, that tends to weigh on stocks. Now, I think the Federal Reserve would like us to believe that the economy is strong enough to sustain these higher interest rates. Yeah, the non-farm payrolls are not so good, but the unemployment rate is still low, and maybe that's the justification for higher stock market prices. But I don't know that this disconnect can last forever. If the yields go up as a result of inflationary pressures and that pushes stocks down, why is this not happening? Here is a very long-term chart from 1992 through present day. The blue line is the 10-year bond. The 1 year is the red line. And we can see, very interesting, notice those periods of time that the red line, the 1 year bond yield, runs up and touches the 10-year and actually kind of spills over. We call those periods of time inverted bond markets when we see the red line just a little bit above the blue line. That happened around 2000. And again, we spoke about this the other day. In terms of it was the 10-year bond yield minus Fed funds. If you haven't seen it, it's actually a really interesting topic. And what happens is that we have a period of low interest rates, like in the late 90s. Low interest rates fuel the economy. The stock market goes up. The bond yields go up. But eventually the Federal Reserve says, okay, there's too much inflation. Let's raise rates. But what happens is they raise rates. Okay, that's good. Both yields go up and accordingly. They've gone up already because of stocks. They go up a little bit more because of interest rate hikes. But eventually the higher yields push the long-term expectation down. They say, well, if we're going to have such high yields, such high interest rates, that maybe that over the long term is going to weigh on the economy. And that's why the 1 year bond stays high, but the long-term expectation goes down. And that's when we see the emergence of the inverted bond market. Notice as the inverted bond market ends, it's the short-term bond that collapses. The 1 year collapse around 2000, 2001 during the tech bubble crash. Then we had a period of low interest rates, 2002, 3, 4. And a little bit past that, we had a recovery. And then we had 10-year bonds rally. And then we see Federal Reserve starts to raise interest rates, 2006, 2007. 1 year bond yield skyrockets, inverted bond market of 2006 and 7. That led to the financial crash of '08. Low interest rates, the 1 year bond mimics or comes very close to where federal funds are. That period of time, 2009 through 15, very low interest rates. The Federal Reserve starts to raise interest rates, inverted bond market. Now we had no idea that we're going to have the COVID economic catastrophe. But the Federal Reserve was actually already cutting rates at that time, very mildly. I think that most likely would have been a soft landing if not for the COVID stock market crash. Fast forward to present day, we had 2021, very low interest rates, lots of stimulus, and then the Federal Reserve sees the inflation and the bond market rallies. And notice how much more the red line is above the blue line. The 1 year is above the 10 year, as opposed to prior inverted bond markets. This was a 50 basis point inversion. This was a 50 basis point inversion in 1998. This is a 150 basis point inversion at its peak, actually a little bit more than that. So, point being is that we're seeing very historic levels. And also the blue line, this is a 10-year bond. Remember how the 10-year bond, when we compared all the different maturities at present day, how it seemed very low? The 10-year bond is actually had historic highs. Here's the blue line, currently, above 4%. The last time we saw a 10-year bond above 4% was around 2006. And that really shows us the level of inflation and the level of growth we've seen in interest rates and yield. So this is where we stand now. We have certainly a lot on the economic calendar in the next 6 weeks between now and the next meeting. And we're going to look at employment numbers. Do the employment numbers soften? Non-farm payrolls year over year is already at, very significant lows. The unemployment rate was at 3.6, now 3.8. It's staying right there. If that starts to go up, that's trouble. Inflation is around 3.5, 3.6%. It's being fueled by very high energy prices. Watch oil especially. If inflation starts to wane, then of course we see probably interest rate hike, maybe not as prudent, maybe interest rate cuts in our future. And of course, wholesale inventories, retail sales, GDP, all the rest of that stuff speaks to the expectation of higher, lower interest rates in the time to come. And we'll be sure to update you along the way with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.